Welcome to another episode of the Michael Yardney podcast. Today we're diving into some timeless wisdom that has guided investors for decades, but with a twist, how these principles apply to property investment. Today, Ken Race and I are going to explore the teachings of Benjamin Graham from his seminal book, The Intelligent Investor. Now, that's a classic in the world of investing, and it's often referred to as the ultimate guide for building wealth. Now you may be wondering, what does a book written in 1949 about the stock market have to do with property? Well, Graham's principles transcend asset classes and offer powerful insights into the psychology of investing that are just as relevant to property investors today as they were to the stock market back then. So Ken Race and I are going to translate Graham's insights into actionable strategies for you. For today's property market, we're going to discuss how to apply these principles to build a resilient and prosperous property portfolio, one that can withstand market fluctuations and help you achieve long-term financial security. So get comfortable and let's delve into what the intelligent investor can teach you about thriving in the property markets.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect, and pass on your wealth through strategic property and wealth advice. Now, here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
Today we're going to dive into the world of timeless investing wisdom, but not the kind you're expecting. We're going to talk about the lessons from Benjamin Graham's classic, The Intelligent Investor. Now, I know you're probably thinking, isn't that a book about the stock market? Well, yes, it is, but stick with me because the insights from this book are absolute gold and they apply just as much to property investing as they do to stocks. You see, investing is investing, whether it's stocks, property, or anything else. And Graham's principles, like understanding the difference between investing and speculating, the power of patience, the importance of having a margin of safety, they're crucial no matter what you're putting your money into. So to help unpack these nuggets of wisdom, I'm joined with Ken Race, Director of Metropole Wealth Advisory, and maybe not a veteran investor at the level of Benjamin Graham, but a veteran investor himself. Hi, Ken.
Hi, Michael. Hi, everyone.
Well, Ken, in the world of investing, there's no shortage of noise. Everyone from this new band of property experts on the internet to your neighbours have got an opinion on where the market's going, what's happening, what the next big opportunity is. But in my mind, if you're serious about lasting wealth, it's often better to tune out all that noise and turn into some enduring principles that have stood the test of time. And Benjamin Graham's book, The Intelligent Investor, is widely regarded as one of the most influential books on investing. In fact, I think it was one of Warren Buffett's classics too, wasn't it, Ken?
That's right. And I sort of noted when I saw this particular thing, I quickly thought of Warren Buffett, who sort of took over Berkshire Hathaway. And when you look at the growth of his personal wealth, for the first 20, 30, 40, 50 years, it was quite modest. But with the law of compounding, he's made more money in the last 20 years than he had in the previous 40 or 50. So patience, get it right. And I think a little bit extra to all the noise of where the next hotspot. What I also are very cognizant about is the gloom and doom sea slayers, if that's what I can call them. That, the market's going to collapse, they're going to do this. And again, they talk general, they don't talk specific, and it becomes headline clickbait. So I think you've got to be careful about both the good news stories and the bad news stories.
I agree with that. Well, let's break down some of the lessons from the book, The Intelligent Investor. And I think we're probably going to then discuss some of those things you just hinted at in a bit more detail. So I think one of the main lessons that I got was I knew it, I guess, but I learned it many years ago. Understand the difference between investment and speculation. That's one of the first distinctions Graham makes in his book. But most people actually overlook this critical distinction, Ken.
They absolutely do. And while certainly for the last 30 years, probably my personal investment journey has been in property, I actually started off in the stock exchange.
Yes, I
You
know.
know, with a chalky, a client advisor, an operator on the stock exchange floor. The principal of the firm that I worked for had this adage that he just made everybody adhere to, and that's do not invest money that you can't afford to lose. And that really makes it clear whether it's an investment grade asset or speculation. People who speculate tend to go, from 0 to 100 very quickly and vice versa. Whereas true investments tend to, even when they go down, they don't go to zero.
Well, I guess Graham's definition of an investment is an operation that, upon thorough analysis, promises the safety of your principal, the money, your equity, and an adequate return. So a couple of points there. Thorough analysis. That doesn't mean somebody's just told you about it at a barbecue, or you heard it on a quick webinar on the internet, or somebody told you about Bitcoin and you don't really understand what it is. But you're right. It's getting safety of your equity, but also to get a return on your funds. And he says anything that doesn't meet these criteria is speculation. But Ken, a lot of people say, oh, that area hasn't performed for a long time. That's its turn to do it. Or there's a new hospital coming up. It's actually going to mean that there's going to be growth, or there's a whole lot of new estates opening up. So they're speculating on hope. Hope isn't an investment strategy.
It certainly isn't. And I think the other thing you've got to be cognizant about is not everything goes the way you want it to go. And sometimes you are going to be forced to sell. So I'd rather be trying to sell, can I say, an investment grade asset than a speculative one, because that'll mean one of two things. You'll sell quicker and you'll probably sell closer to what you think you should be getting.
Makes sense. At the moment, these people thinking of buying off the plan, I actually can't afford to get in the market now, so I'm going to buy because it's going to be worth more on completion. Doesn't always work. Or, hey, I hear that commercial property is the right way to go, but it's not for them at that stage of their investment game. They're not at that level yet. So there's a lot of speculation happening. So lesson one was understand the difference and make sure you're investing, not speculating. Another one, and interestingly, you already hinted at it in our introduction, Ken, the lesson, one of the most profound lessons from the intelligent investor is the concept of patience. What are your thoughts on that?
Property, particularly investment grade properties, don't double overnight. The share market might, but that's probably on a speculative share. So the good thing about long-term investing and property is they fit like a hand in a glove. Property should be long-term investing, and it's that law of compounding that really creates that benefit. So the longer you hold it, the longer that you've got to go through cycles, to pick up any, if you like, dips in the market. And you shouldn't be driven into a sale, if you like, when you see the headlines of doom and gloom. You've always got to go back. Was the fundamental research that I put in place still valid when I bought that property?
Yes.
Have my objectives or goals changed? And if all that's right, then I think courage with a lot of patience, so I should have said patience with a little bit of courage, actually allows you to stay the course, because property does have very high entry and exit costs. So you've got to be very careful just going in or out over short periods of time, because there's large dollar values that you pay, capital gains tax, stamp duty, to name a few.
Well, interestingly, in his book, Graham introduces the concept of Mr. Market. Mr. Market's a metaphorical figure prone to wild mood swings. He often wants to buy or sell assets at irrationally high or low prices, depending upon his emotional state. And the key lesson is not to be swayed by Mr. Market's moods, but to stay disciplined and focused on your long-term strategy, which is what you just said, Ken. And as you said, in property investment, patience a virtue. Oh, actually, it's more than that. It's a necessity, Ken, because it's a long-term game. And to me, it's a 20-year game at least. Medium term would probably be 10-year. So we're not talking about the quick ups and downs of the stock market. We're talking about time to realize its full potential, allowing leverage, compounding, and time to work its role. Anyone who bought a property in Melbourne or Sydney 20 years ago, Brisbane, any of the capital cities, would be laughing now. Who wouldn't have liked to buy the property their parents bought 30 years ago at the price they paid? But during that time, there were long periods in Perth where the market didn't go up, and now it has. There were long periods in Melbourne where the market's overperformed, and it hasn't for a while. It'll catch up again. Same with Sydney and Brisbane. Despite the ups and downs, those who held onto their properties have had substantial gains, both in capital growth and also rental income. And all the little concerns along the way, stamp duty or land tax. Are they going to change the land tax rules? Are they going to change the rules on regulations on residential tenancies? They don't actually make much difference if you have a long-term goal, do they, Ken?
That's right. So it all comes back to that thorough research. And the other thing that you overlay over that is time. So we've all heard the adage, everyone can become a property millionaire if they live long enough. Well, we don't want to be forced to live 100 years to make money. But one of the simple tools I use is how long does it take that property to double? So compound growth. So if we look at a property that's growing at 7% annually compound, that's a figure, then that property would double every 10 years. If we then look at a property that's growing at 10% per annum compound, then that will double over 7 years. So a better investment grade property growing at a better rate buys you 3 years. And you've got to say to yourself, what would I have done in those 3 years? Could I have bought the next investment? Could I have upgraded it? Will it help me into retirement sooner than I would have otherwise been forced to? So having that good investment grade property has many advantages.
Oh, you can't expect a grade return from a secondary property. So the quality of the property is paramount. Now, interestingly, some people are in a hurry. Some people come to us at Metropole and they want to get involved in property development when it's too early in their career, or get involved in commercial property when they haven't got a big asset base, or I can't do it on my own. Can I go with my uncle, my brother, my auntie, my sister? And so what we do is start off by putting a strategic plan in place for them. And one of the elements of that plan also is everybody gets to see one of your team with regard to ownership structures, to make sure that if they are planning to become the people they plan to become, that they have the right ownership structures in place. It's also complicated because when you're starting off getting into property, you don't often think about where you are going to be in 10, 20 years' time, even though you and I have just kept talking about how important that is. And so people don't set themselves up right for then, Ken.
That's right. And when we start buying property, we don't know what the future is going to hold. And, I get this sort of client all the time who, started off in life, entered into a business, worked their way up through management, senior management. And I tell the story of this chap that became a client many, many years ago, well over 10, maybe 20 years ago, who became the factory manager. He did an engineering degree, bought a home, bought an investment. All of a sudden, he's the factory manager. And one of the directors came to him and said, thank God, he did use that word, but thank goodness that I now don't have the day-to-day responsibilities of occupational health and safety. And you now have it. And he thought to himself, that home that I've bought, the shares that I bought in my name, what happens now? So asset protection is an issue, and we've got to understand the ramifications and try and understand, if you like, the strategies to help minimize that if you end up being in that situation.
Well, that almost leads into the next point from Benjamin Graham, his concept of margin of safety. It's one of the cornerstones of what he says of value investing. Now, to me, it actually refers to those financial buffers or cushions that you protect yourself with from errors of judgment, unforeseen market downturns. So for us, when we help our clients set up their property portfolio, we buy them time as well as property by having financial buffers in place. But it actually also takes a number of other forms in my mind, buying the property below its intrinsic value. Not too difficult to do today, actually, when the cost of many established properties, particularly apartments in the capital cities, can be bought considerably below replacement costs. So that gives you a margin of safety that you couldn't replace it. And having that buffer for unexpected financial buffer for unexpected costs, vacancies, repairs, economic downturns, and also protecting yourself, Ken, by having the right ownership structures and insurance, protecting yourself that way, because in many ways you are your biggest asset, your income earning capacity.
Correct. And that financial buffer to me is irrespective of the asset you're buying. If you've got a margin loan for shares, whatever. So I think of it a lot more broadly. And property is one of the few asset classes that you can actually influence its price. If you buy BHP shares, that's the price today. So for me, the buffers are certainly the financial one, and it's not the dollar value, it's more the years you want to buy. So how many years safety do you want? I also look at the ability to manufacture equity. How can I actually improve my return on that particular property? And the other thing that a lot of people ignore is after they've bought the asset, it's managing the property. So good property management actually helps you maximize the return on that property, which is really, that's what you're doing. That's your ability to hold the property until the capital component comes home to roost.
Yeah, somebody left a comment on Property Update. I love that people leave comments and I interact with them. And he said, you don't need a property manager. All my properties are in Western Australia, in Perth. He's probably listening to this podcast. And because they are, I know what's going on and I can look after them myself. And I cringe when I hear that, because Western Australia hasn't had so far all the legislative changes that most of the other states have got. But still, it's so hard for full-time experts to keep up to date with the legislative changes, especially since we know that they're all in the favour of the tenant, not of the landlord. So you're right, property management is critical. Lesson number 4 from Benjamin Graham's book, The Intelligent Investor, was to avoid the herd mentality. Graham warns against the dangers of following the crowd. I mean, the stock market's full of people investing in the latest trend. Same with Bitcoin. I know a couple of my kids invested in Bitcoin early in the piece. And you know what? They actually made money out of it. It worked well for a while. No idea what they were doing. But everyone else was doing it on Instagram and TikTok, so let's do that. And the same can be true for property investing. But I guess Warren Buffett said it differently: be fearful when others are greedy and be greedy when others are fearful.
That's right. And to me, herd mentality is, it's almost too late. And I sort of come to the conclusion of, imagine if we had a crystal ball. So in property investing, we actually have 2 crystal balls. If you're buying a property that's got 20, 30, 40 years worth of history, you've seen what it's done. You understand, repairs, maintenance, if there's any issues. But more importantly, when we get back to one of those first principles about thorough research, when the rest of the crowd know what's happening, the smart investor actually knew months ahead. They understood what was going to happen to the market through research, through working with people who are in the industry day in and day out. So they've actually got in ahead of the curve, ahead of the crowd. And that creates a bit of a return, a supercharged return compared to the rest of the crowd.
So it's hard to resist the urge to follow the crowd. It's human nature. You feel comfortable there. But in my mind, one way to resist that is to have a clear investment strategy. And then, of course, you need the discipline to stick to it. And that's why at Metropole, we believe before even making any property investment decisions, we first have to help our clients build a strategic property plan, taking into account their personal circumstances, their financial position, how long their time frame is, and what their goals are. So it all starts with a plan. So the most common thing people come and ask us is, what are your fees, or where should I buy, or where's the next hotspot? And they get disappointed when we don't talk about property first. We talk about them. But I guess the next lesson from Graham, was he emphasises the importance of discipline in investing. Stay disciplined and stick to your strategy. So again, it's easy to get caught up with the excitement of the rising market, the strong property markets in various parts of Australia. But successful investors are those who've got a clear strategy and stick to it no matter what the market is doing, Ken.
Correct, up or down. And
Yes.
I think when we at Metropole work with clients, we spend a lot of time to understand and for them to understand what their strategy is, what their goals are, what their future goals are, and actually build around that. It's no good going and buying an investment property using up all your borrowing capacity if you want to buy a home over the next couple of years because you want to start a family. So investing in property, particularly if you've got a strategy and a plan, will help you understand, do I buy the investment property first? Do I buy the home first? Do I rent vest? So that strategy takes all those things into account. And therefore, because it's got flexibility built in, because we know the world won't always go the way you want it, then unless there's major changes in how you set up that strategy, your goals, your aspirations, etc., then unless there's a fundamental change, you stick to your strategy. That's why I use the word courage. And you get courage by expanding your level of comfort, your comfort zone, which means talking to people who understand the market that you're in, who are not in it once every 2 years or 3 years, but operated in it day in and day out.
So first of all, you've got to have a clear strategy, have criteria for the sort of properties you want to invest in, the locations, the financial metrics you need. But I think it's also important to then regularly review your portfolio and review it with somebody else because you're too emotionally involved. You spent all the time, effort, money, emotion buying that property a number of years ago. Markets change, and so do your financial circumstances and your goals over time. So periodically assessing firstly, how your investments are going to ensure that they align with your long-term strategy, and also seeing, is the strategy still appropriate? Have you chosen the right strategy? That's going to stop you making mistakes. It's going to stop you buying the wrong sort of properties or selling a property when you shouldn't be. So focus on the long-term potential. Now, another lesson from The Intelligent Investor by that great book, Benjamin Graham, was the concept of diversification as a means of managing risk. Now, in the stock market, it actually means spreading investments across different industries, maybe even different countries. Now, it's not as simple with property, which is bigger and bulkier and more expensive, but the same principle still does apply to property, doesn't it, Ken?
It certainly does. And I think it's even more important because diversification in property is the type of property and the location, obviously, the type of property, residential or commercial. But I think it goes one step below that because different locations have different property cycles. You know, one market could be going up while one is coming down. Buying in different locations can help you with your land tax. It can help you with refinancing. But there's a whole discussion on financing because one property could be in one location stable while another one's gone up. So therefore, if you've got the right finance strategy in place, you can actually borrow more. So all those things lead to you being a better investor to achieve your goals, can I say, less risky, but certainly in a shorter time frame.
I guess it's also talk about the mix of properties. You may want more capital growth properties. Maybe you need higher yielding properties such as commercial properties, especially if you're at that right stage of your cycle. I think the concept really is by diversifying, you create a more resilient portfolio that can weather the market fluctuations, providing you with stable returns. Another lesson from that great book, The Intelligent Investor, was be skeptical of market predictions. Graham was famously skeptical of anybody's ability to predict the market's future accuracy. Now, of course, he was talking about the stock market. Boy, just look at the predictions of only a couple of years ago where the Reserve Bank said interest rates were not going to go up till 2024, or those people who predicted the stock market crash or the property market crash or the recession or the mortgage cliff or the fixed rate cliff or the unemployment cliff, all those cliffs that haven't come to fruition. Unfortunately, though, the media keeps throwing those at us, Ken, because it's not the media's job to educate us. Really, what they're trying to do is get us to click on their links so that the advertisers who paid them get people looking at them.
Scare the hell out of us, so we read the article.
Yeah, yes.
People will have their own decision-making process depending on their personal circumstances. And we've talked about here the media. They've got their own reasons. They have to sell circulation, get some advertising. Different property people, particularly the gurus, if I can call them that pop up every time the market starts to become overheated. Their main aim is to sell any property. And I think that's the difference. People don't buy the market. They don't buy property in general. They should be focusing on buying a particular property. How has that property done? Does that particular property meet my long-term goals? And if you buy the right type of property, as you said, not necessarily off the plan, you buy an existing property, you can actually see its history. So when we talk about average growth rates for property, that's exactly what that is, either average or the median. But if you look at a property that's 30 years old, that might have sold 3 or 4 times, you can actually see its price movement. And then you can more accurately estimate what its future growth will be. Although we say historic performance is no indication of future, but at least it gives you a leg up better than I'm buying a property in an area that has no history.
Yep, makes sense. Another one of Graham's key insights was the importance of having a defensive investment strategy. In other words, one that prioritises the preservation of your capital, your equity, and minimises your risks. We sort of discussed that a little bit before, but in Graham's view, the defensive investor should focus on minimising losses rather than maximising gains. I don't know, for property investors, probably the defensive approach translates to being conservative with leverage, choosing properties that will always be in strong demand by a wide range of owner-occupiers who are going to push up the prices and tenants who are going to pay your rent, ensuring solid capital growth, solid cash flow from having the right property in the right location, and I guess avoiding those speculative investments that we've mentioned a couple of times, Ken. I guess it means being realistic about your own risk tolerance too, and not overextending yourselves. But some people just don't recognize they're overextending themselves. And that goes right back to the first point. They're speculating, Ken.
Correct. And unfortunately, we've seen that over the last short period of time where people borrowed money, can I call it, at about 2%. And then all of a sudden now are at 6.5% or whatever their specific number is. And how do I afford it? Or they thought they could afford it at that low rate and then got into a fixed loan rate. And then all of a sudden you come out of fixed into variable, and just overnight, although the bank gives a few months introductory leeway, all of a sudden your costs go up. So that's why you need to have those financial buffers in place to actually allow you to a cash flow. It means you need a good finance broker, because buying property, I don't think we've said this during this podcast, is all about finance, money. and we just use that to buy property because of all those intrinsic benefits that it has. So got to have the right finance in place, buy in the right name. If you do all that right, that becomes your defense when things go bad.
Well, let me just expand a bit what you said, because part of the defensive strategy is owning your properties in the correct ownership structures. And that's to not just for tax. People say do it for tax. It's not. It's for asset protection and future intergenerational wealth. And I know that's what you and your team at Metropole Wealth Advisory specialise in. So before we mention the last couple of lessons from Benjamin Graham's great book, maybe you can explain a bit about what your team at Metropole Wealth Advisory do and how you're different. Because even though you are an accountant, you're not doing accounting work. Well, sure, we have a financial planning arm, but how do you help our clients?
So we take a more holistic position. And by holistic, I mean a more complete picture. And we find that people need input into many different professional areas: the accounting, the tax, the asset protection, the estate planning. How do I pass on those assets? What happens if I get divorced? How do I help my children? So if I substitute the word complete instead of holistic, we look at a wide range of inputs. And therefore, that strategy works in combination with everything else you do. And as such, then you get a better a picture. You can see the picture a lot clearer. And one of the more unique things we do is we then talk to a client's other professional advisors about the strategic issues that we've raised. And then that way, it means that the client themselves doesn't have to go and talk to another professional in, can I call it, a language they may not understand? And we understand then what needs to occur. And in a majority of cases, if that other profession doesn't know because they haven't done it enough, it's a strategy they haven't used before, we show them and tell them what to do. So execution becomes a critical part to this plan.
Well, I think a lot of people invest in property because they want a property, but that's actually not what they want in the long term. What they're looking for is choices in life in general. They're looking for financial freedom. They're looking for passive residual income. Property is the vehicle to get there, and building a substantial asset base, whether it's property, and it shouldn't only just be property, it should be a combination of things. We believe property shares, various sorts of property, as we said a moment ago. So therefore, if all you're doing is getting property advice and not holistic wealth advice, you're shooting yourself in the foot. You're not actually going to have the opportunity to get into that small group of investors who outperform the markets. Ken, we often quote the statistic that 92% of property investors never get past their first or second property. And a recent audit, well, it was a couple of years ago now, the results of our clients showed that they're 7.3 times more likely than the average investor to own 6 or more properties. Now, I don't know what the people listening to this are going to be able to achieve. What I do know, though, is our clients have made the right decisions because they got the right advice. So if you're keen to develop that financial freedom yourself, and if you want to pass it on to future generations, I'll leave a link in the show notes. Go to metropole.com.au and have a chat with either our strategic property team or Ken's wealth team. We understand all this. So the defensive investment strategy is what we do. We don't speculate with our own money. We don't want to speculate with yours. There's 2 more points in the list of things I'd come up with, the 10 lessons from the intelligent investor, even though there's lots more lessons within the book. Graham emphasised the importance of investing based on the intrinsic value of an asset rather than its market price. And he was really focused on long-term, not short-term gains. Now, I've often spoken about buying below intrinsic value, and it's interesting that I didn't pick this up from Graham's book, but it actually makes sense. The lesson is particularly relevant to property investors who might be wanting those, as we've already said a few times, the short-term gains, the quick flips. Focus on the long-term value of your property. And at the moment, as I said, it's not hard to find properties below intrinsic value because the cost of replacing apartments, houses, townhouses has just shot up amazingly over the last couple of years, Ken.
Yeah, and I think an extension of that is buying properties with a twist. And I think when you said buying off the plan, buying house and land, it's the old economic adage of supply and demand. If you buy in an area where they can't build more, that's got to get you off on the right foot. Whereas a new land development, they do it in stages. So here's the first 300. And when they finish that, they do the next one and the next one. So it takes you decades for your particular property to grow. And it's the same with a high-rise apartment block. Although, obviously, with planning approvals, they don't do them overnight, but they can build another apartment block. And all of a sudden, there's another 300. But more importantly, if you're one of 300 and you're wanting to sell when there's 50 others trying to sell in that same building, then you've got issues. So with a twist to me is, why is that particular property outside of what is common with any other property?
Sure. So it's the property, but it's also the location, looking for areas that are gentrifying, that are going to outperform the averages because the people wanting to live there can afford to live there. The last lesson I'd like to share from Benjamin Graham's book, and one of the most profound lessons, is the idea that often the biggest threat to your success as an investor is not the market, but your own emotions, your own behavior. I remember Mark Twain saying something along the lines of, it's not what you think you know that's going to get you into trouble. It's what you think you know that isn't so that's going to get you into trouble, Ken.
Yeah, it's what you don't know, you don't know, you don't know. And that either gets people into a property too quick that they shouldn't have bought, or conversely stops people from investing because they haven't expanded that level of comfort. So education to me is one of the biggest tools, or the biggest, when we were talking about safety nets. Educate yourself, knowing that you're not going to be as expert as people who are operating in the markets every day. So educate yourself, get advice from the right people, don't follow the crowd, and do that research and have that courage to, if you like, stick with your decisions and strategy unless there's a fundamental change in what's happening in your life.
Well, we're human, and that's the problem. Humans don't act rationally when it comes to money. So you get the psychological traps of FOMO. When you hear everything's going up in value, you think you're going to miss out. It leads to poor decisions. Or the opposite, I guess, panic selling during downturns. Or others just become overly attached to their property as which isn't performing, which is what I mentioned earlier on. One has to have a review. So I guess that's part, again, the reason of having a strategic plan and a wealth plan like your team at Wealth Advisory put together, and only making decisions based on the plan. It'll tell you what to do and what not to do, Ken.
That's right. I mean, you've got to have a strategy, and then your investment decisions fall in behind that. So do those investment decisions support the strategy? That's why you've got to spend so much time on the strategy. And it's got to be flexible, and you've got to really, can I say, go away and think about what your goals and aspirations are, not what you would like them to be. Or, I sometimes get clients that, can I say, more elderly than they are young. And, all of a sudden they want to buy 10 properties in the next 5 years. They've bought none up to now. So you can't create something out of nothing. But given that each property decision is part of that wealth creation, every single property should have the decision making that supports that strategy. Even if you buy one property and one property only, make it the best you can buy to help you achieve your objectives.
I think that's really good advice. I mean, I really appreciate our chat, Ken, because it was interesting to get your thoughts. Benjamin Graham's Intelligent Investors, a treasure trove of wisdom. It's guided investors for decades. And what we're trying to do is say, by applying these principles to property investment, the average Australian can build a strategy that's not only resilient, but it's aligned to their goals. It's going to help them. So my recommendation is employ these timeless principles into your own property investment strategy. That means you're not just following the path of an intelligent investor, you're ensuring your journey in real estate is going to be grounded in wisdom and built to last. Thanks for your time, Ken.
Thank you, Michael. Thank you, everyone out there.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In today's mindset message, I'd like to talk to you about 6 things money can't buy. Now, the theme of my podcast is property investment success and money, but I've often said that any problem money can solve isn't really a problem. And maybe this is true for business and investing matters, but that said, there's still a lot of things that money can't buy. You'll never look back on your life and wish you had spent more time at work, or reminisce about all those fun times you literally counted your money. Sure, we all need money to survive and thrive, but it's vital in my mind that we keep a balance between our financial goals and all those other things that give us true, priceless meaning to our lives. It took me years to recognise this, so I'd like to share this with you because sure, money can help solve lots of problems, but always remember there are some wonderful things that money just can't buy. Like Money can't buy happiness. Buying things that give us instant gratification, especially these days when we purchase items from anywhere in the world, just from the comfort of our home, and sometimes without even worrying about them thanks to credit cards or Afterpay. Sometimes we confuse this dopamine rush, this quick rush, with happiness, but it doesn't last. Now, I know a lot of it happened over COVID when people are locked down, and I remember there were two sorts of days: the sort of days you bought things online to make you feel good, and the days where you got rid of the things you bought online that you really didn't want. Now, so what I'm suggesting is that money isn't going to buy you happiness. And it can't buy you wisdom. You might be able to prepay a university course or attend fancy conferences, but some of the most brilliant and passionate people you'll ever meet aren't those who studied at Oxford or Harvard, but they've gone through, I guess, what I'd call the University of Life. Knowledge is about more than just lectures and textbooks. So go out there and live your life. Now, unfortunately, over the last couple of years, we've also learned that money can't buy good health. Sure, money can pay for top-notch medical insurance and medical care, but it can't keep you healthy or alive indefinitely. Many people work themselves into the ground in their pursuit of money at the expense of their own well-being. It often takes a serious illness, injury, or something like that to stop you in your tracks and force these people to reassess their priorities. And sadly for some, this wake-up call happens too late. Now, money can't buy you friendship. If you don't believe me, just ask somebody who's won the lottery. There's always family members, other people, long-lost friends who come, or when, unfortunately, somebody dies, they'll find money problems amongst family as well. No amount of cash can buy real friends who are going to laugh and cry with you, keep your darkest secrets, dry your tears with their sleeves, and let you share their slice of cake. So as I go through things money can't buy you respect. Like friendship, respect's earned and it's not transferable for cash. There are lots of very wealthy people out there who you've probably got no respect for. Am I right? You can probably name a couple of tycoons and politicians off the top of your head who are probably drowning in money but have got zero credibility. People respect your actions and your values, not your bank balance. And money can't buy true love. Look how many movie stars, sports people, other rich celebrities end up with poor relationships. You don't see many in lifelong happy relationships. So having lots of money doesn't guarantee their relationships are going to succeed any more than for mere mortals like you and me. Money might get you the attention you desire, but for the wrong reasons. So what can money buy you? It buys you freedom. It buys you choices, which are some of the most valuable commodities in the world today. It buys you experiences that you're going to remember long after they're over. And with financial security comes the ability to choose how you spend your time, where you work, or how hard you work, or for how long, along with a myriad of other decisions that you can make that will make or break the quality of your life, because you're going to have options, you're going to have choices. So money in itself won't make you happy, but boy, does it open up opportunities in life that make all the difference in delivering a full and adventurous and vibrant life. So my mindset message to you today is, sure, invest and work hard at accumulating wealth, but remember what's really important in life. Thank you for spending the last little while with me. I hope you got some benefit from this show. Hey, but before you move on to the next podcast you're hoping to listen to, please let me remind you that I have another show that I produce once a week with leading demographer Simon Kirstenmacher that we call Demographics Decoded, where we unveil the trends that are going to shape your future. This is a must-listen to podcast for anyone interested in property investment, business, or entrepreneurship. So if you don't currently subscribe to Demographics Decoded, please stop for a second, subscribe on your favourite podcast app or on YouTube. Now, if you did enjoy today's show and you know somebody else who'd benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. There's a share button on every podcast app. On Apple Podcasts, there are 3 little buttons at the top of the player. Or just talk to them, tell them about the Michael Yardney podcast. I hope you're going to be doing them a favour. You're definitely going to be doing me a favour in helping in my quest to make as many people as possible financially literate. Now, you can catch up with me in between these shows on social media, or you can join my private Facebook group. Just go to Facebook and look for the Property Update Facebook group. And I've got a special bonus for you to say thank you for subscribing. Just go to podcastbonus.com.au. There's a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. That's my way of saying thank you to you for taking the time to listen. Oh, by the way, if you haven't listened to the many podcast episodes we've already got, we're well into our 600s of episodes now. You can always listen to the old episodes, which each have lessons about property investment, success, and money. Once again, thanks for listening to today's show.
Thanks for listening to this episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect, and pass on their wealth through strategic property and wealth advice. If you like what you heard and don't already subscribe, you'll find us on iTunes or on your favourite Android app as the Michael Yardney Podcast. Watch out for our next show, which comes to you twice a week, and you'll learn some new ideas about property investment, success and money in around 30 minutes. To get more of Michael's thoughts, go across to www.propertyupdate.com.au and sign up for his daily morning briefing, and you'll hear from not only Michael but a group of leading property success and money experts. And just a reminder that the information you heard in this show today is general educational advice and not specific investment advice, as we don't know your personal circumstances. If you're looking for specific advice, why not ask the team at Metropole to help you?